Welcome back. Let's focus on the banking space. This morning, the Nifty Bank hit a fresh record high. But today we have, an analyst coming in from Morgan Stanley. And they believe that the tail risks for banking sector have actually decreased. An improving liquidity and easing regulatory environment are the big positives. So how do you bet on the banks, and what banks, more importantly, you bet on? Sumeet Kariwala, the India Banks Analyst at Morgan Stanley, joins in. This obviously from the sidelines of the Morgan Stanley Annual India Investment Forum, which is currently underway. Sumeet, thank you so much for joining in. That really is the first question, we're close to near all-time highs for the Nifty Bank. What should one look at in terms of incremental gains coming in from the space, and what would you bet on? More the private sector, large public sector, or the ones which have not moved at all in an otherwise, fairly uptrending banking space?
Yeah, hi. Thanks for having me on this show. So with respect to the sector, it has done well, and that is after a couple of years of underperformance. So it's a welcome positive. I think with respect to the sector, next 2 quarters will be tough on earnings. We see more downward revision to earnings, but I think so the outlook from a second half of fiscal 26 and fiscal 27 is getting more and more positive. There are 3 aspects to growth that I would look at. One is demand. And if I look at the income tax rate cut in the budget, the interest rate cuts that the RBI has done, and they're going to do more, that'll imply that demand is much better going forward. The second aspect is competitive intensity, and I think so this is less appreciated. The incremental spreads of lending in a number of segments, say, take for example, mortgages, is very low. And a lot of private sector banks have slowed down growth in these segments because they don't find business to be quite attractive. Now, that's the second important driver. If in second half the spreads improve and the competitive intensity normalizes, that'll also support growth. The third is external factors, anybody's call. And once you have more clarity on that, the earnings outlook will improve that much. Margins will be weak. Next 2 quarters will be tough. There's some bit of lead lag, but the net impact of falling rate cycle is negative on margins. So next 2 quarters will be tough. Second half fiscal 26, fiscal 27 look quite good. You asked me on my framework with respect to identifying stocks, and I would want to spend some time on this. Over the last year, we've been articulating that this cycle is all about profitability. If you look at 2010 to 20, the stocks which did well had asset quality on their side. So if you don't have an asset quality problem, the system was going through this. You had a clean slate. You could gain market share, outperform, and do well. This cycle, I don't see asset quality challenges. I don't see large banks to have competed on underwriting. They've competed on pricing. So any bank over the next 2-3 years which can deliver on profitability is going to not only do well on earnings, but also re-rate even from here.
Okay. Sumeet, I wanted your opinion on the 2 segments clearly. The large size banks, the front-facing banks, as well as the mid-size banks when it comes to key metrics, as well as, say, the valuation gap between the 2.
Yeah, so we've been articulating that the large private banks will continue to outperform in terms of valuations. This cycle is very different, as I said, in terms of profitability. What has happened over the last 4-5 years? Let's take a step back. There is a lot of competition in secured lending. The spreads have come down. Liquidity is a very different challenge now. Historically, if you raised 100 rupees of deposits, you had to provide for CRR, SLR, and you were done. Now you need to provide, maintain liquidity based on the category of deposits. A retail deposit will have lower liquidity requirement and so on. This basically changes the construct of managing liquidity on the balance sheet. There have been a lot of changes by the regulators, which has capped fee income in certain segments. So overall, if I look at like-to-like margins, they've come down. In that backdrop, there are 2 or 3 things which can help banks outperform. One, improvement in loan mix. Second, operating leverage. And third, potential to improve liability cost. If I look at across the sector, large private banks are much better placed to do this. and therefore we think they'll continue to re-rate and outperform the mid-sized private banks.
You know, basis the list of stocks that you've put out in terms of recommendations, etc., the one that stands out is IndusInd, where you have an equal weight, and the other one is Yes Bank, where you have an underweight. I'm asking you this specifically because of the problems that have taken place in IndusInd. At what point do you revisit your thesis here, and where does that stand at right now?
Yeah, so I don't want to comment about individual stocks, but what I would say is that when I look at the mid-sized private bank sector as a whole, we want to be very selective. A lot of profit pools, be it with respect to MFI, credit cards, they have seen a structural decline in profitability. And that is something which is required to make money if you don't have a liability franchise which is as good as large private banks. So we've been very selective in this space. We have very few overweights, and we think unless the structural profitability in certain segments kind of improves more than expected, the large private banks will remain our favorites.
Okay. Well, you know, Sumeet, the news for today is this entire Vodafone Idea issue. What is your reading of it? Have the banks, the exposure to banks, I think is around 2,300 odd crores, have the banks fully provided for it? Is there any kind of issue that you would probably see in that? And secondly, you know, the experts who we've spoken to have said that it's a risk when it comes to the entire industry that you're talking about. It's not only Vodafone Idea. From that perspective, what's your call?
Yeah, so I don't want to, again, comment on an individual entity, but what I would say is if you look at the asset quality problem today in the corporate segment, it's negligible. So even if you have some accounts slipping here and there, it's going to be very manageable from a banking sector perspective. In fact, 50% of the banking system is currently working at negative credit costs because the recoveries from old NPLs are so high. So again, I don't think so asset quality is a challenge in this cycle. Will there be some impact on asset quality because of external factors? Possible. We'll have to see how the entire tariff situation plays out. But the point that I would want to make over there is that the balance sheets are quite healthy, be it the corporate segment, SME segment. We've come out of a long drawn NPL cycle. And over the last 3-4 years, there's no significant re-leveraging of, say, corporate or mid-corporate or SME balance sheets. So they are capable of managing the situation unless it's very different than what we would assume right now.
Right. You know, I have a two-part question, Sumeet. So on the one side, there is no real NPA situation that is happening in the very near future. You've assigned very, very low risk probability to something like that. If that were to happen, where would you see any sort of stress emerging? Would it be retail at current levels or not? Because typically it has been seen as one of the safer sides to bet on. That's point number one. But secondly, while NPA or asset quality risks are declining, there has not been a big loan cycle which has come up as well. When do you expect that to turn?
Yeah, so when you look at overall loan growth, it has been largely, say, 1.2, 1.3 times nominal GDP over the last 2-3 years. But there are segments which have grown very aggressively. Look at unsecured, credit cards, personal loans. They've grown much faster. They've grown 2-3x faster than the overall loan growth. And you've seen some stress come out in those segments. It's not very material in the overall scheme of things because, as I said earlier, the large banks didn't compete on underwriting, they competed on pricing. So you did see some skeletons come out. The same would be applicable in the MSME segment. This segment has grown very aggressively, both by the private banks and the state-owned banks. And if the situation really deteriorates, this is the portfolio that I'll be watchful. Having said that, I'll make one more point on the MSME segment. In my view, MSME of this decade is like retail of last decade. If you look at credit multiplier or loan growth over the last decade, it was not, it was like, say, 9-10%. Still, retail grew at, say, 17-18%. The same is applicable for MSME. The segment is going to do quite well even if GDP growth is muted. There's a lot of underpenetration. There's a lot of formalization. So I would not worry about that. But yeah, if you will tell me, okay, tell me one segment which we would be watchful, it's MSME.
Okay. Just a quick last question then, Sumeet, and just a brief answer. So on top of the list for you would be the large cap banks?
Yeah, large private is where we are excited about.
And following that?
So following that, we've been very selective. So there are certain banks that we like in the mid-sized private banking space. There's a relative outperformance that we expect within state-owned banks.
Sure.
But all of those are tactical ideas. When I think about the next 2-3 years, I think the dispersion with respect to earnings and therefore valuations between large private banks versus the rest of the sector is going to surprise people.
All right, Sumeet, we're going to leave it on that note. It's been a pleasure. Thanks very much for joining in and speaking with us. So that's the view coming in from Morgan Stanley on the entire banking and financial space. As of now, we need to take a break with the news, in fact, that we're seeing further profit booking seep into the market. So we have the Bank Nifty, which is now down around 0.4%, and the Nifty, which is down around 100 odd points, along with the Sensex, which has lost around 0.5% as well. We'll take a short break, but up next, we'll in fact full tilt on the market. We have Sachatan and Utikar joining in to talk about the technical.